Two people. Same $30,000 saved. Person A puts every dollar into an S&P 500 index fund and does not touch it for 30 years. Person B uses that $30,000 as a down payment on a rental property and rents it out for 30 years. Who ends up with more money? If you already know the answer, I promise you at least one number in this video is going to surprise you. And if you think you know the answer but are not sure about the math, what you are about to hear is going to change how you think about both of these investments permanently. Because the real math is not what either the real estate crowd or the stock market crowd is telling you. Both sides are cherry-picking numbers. Both sides are leaving out the details that make their investment look worse. And today we are going to ignore both camps and just let the actual data from 2026 speak. Drop a comment right now. Before you hear a single number, which one do you think wins? Real estate or stocks? Drop it below. I check every comment on this channel. Welcome back to Rich Habits. Subscribe if you are new here. If you are the type of person who gets bored when someone tries to explain investing and clicks away after 30 seconds, go watch TikTok and let someone else get rich while you stay confused. But if you want the actual numbers broken down so simply that your 15-year-old could understand them, stay right here. Because I am going to explain both of these investments from scratch, in the clearest language possible, and then let the math tell you the truth. Let us start with what we are actually comparing. Because the biggest mistake people make in this debate is comparing the wrong things. When people say real estate, some mean their house. Some mean a rental property. Some mean commercial buildings. Some mean REITs, which are real estate companies you can buy like a stock. These are completely different investments with completely different return profiles. Today we are specifically comparing two things: owning a rental property directly, and owning shares in an S&P 500 index fund. Everything else is a separate conversation. Now let us make sure everyone watching understands both investments from the ground level before we get into the numbers. An S&P 500 index fund is a single purchase that gives you a tiny ownership stake in 500 of the biggest companies in America. Apple, Microsoft, Amazon, Google, Coca-Cola. All 500 of them at once. When those companies make money, their stock price goes up and your investment grows. Some of them also pay you dividends, which is a share of their profits sent directly to your account on a regular schedule. You do not manage anything. You do not fix anything. You do not call anyone. You just own it and let it grow. A rental property is a physical building that you buy, usually with a bank loan covering most of the cost, and then rent to tenants who pay you monthly. Their rent pays your mortgage, your maintenance costs, and hopefully leaves money left over every month that goes directly into your pocket. The property also tends to increase in value over time, which adds to your wealth even if you never sell it. Both of these build wealth. The debate is which one builds more. And the answer depends entirely on a concept called leverage, which most people have heard of but very few people fully understand. Here is leverage explained the way I wish someone had explained it to me. Imagine you have $30,000. You want to buy something worth $150,000. With stocks, you can only buy what your money covers. $30,000 buys you $30,000 worth of stock. Period. You can use margin borrowing in stocks, but it is risky and most financial advisors do not recommend it for regular investors. With real estate, the bank will lend you the rest. You put down 20%, which on a $150,000 property is $30,000, and the bank gives you the other $120,000 as a mortgage. You now control a $150,000 asset for an out-of-pocket cost of $30,000. Here is why that changes everything. If that property goes up in value by 10%, it is now worth $165,000. Your $30,000 investment just gained $15,000. That is a 50% return on the money you actually put in. Not 10%. 50%. Because you were controlling 5 times more asset than your cash alone could buy. That is leverage. And it is the primary reason real estate has created more self-made millionaires than any other single asset class in American history, despite stocks having higher raw returns when measured purely on appreciation. Now let us look at what the actual 2026 data says about historical returns. Because this is where both sides constantly argue and where the truth is more nuanced than either camp admits. The S&P 500 has delivered an average annual total return of approximately 10.39% from 1992 to 2026, including dividends. That is one of the most consistent and reliable return records of any investment in the history of capitalism. 100 years of market history. Wars. Depressions. Pandemics. Tech bubbles. Financial crises. And through all of it, the S&P 500 delivered an average of 10% per year. U.S. residential real estate has appreciated at approximately 3.8% per year based on the Case-Shiller Home Price Index from 1987 to 2024. That is the appreciation number. But that is not the total return number, because appreciation is only one of 3 ways rental real estate generates wealth. The 3 ways real estate builds your wealth are appreciation, which is the property going up in value, rental income, which is the monthly cash after your mortgage and expenses are paid, and principal paydown, which is the mortgage being reduced every month by your tenant's rent payment, silently increasing your equity without you writing a single extra check. When you add all 3 together, the total and leveraged return on rental real estate runs between 7 and 13% annually depending on the market, the property, and how well it is managed. That is genuinely competitive with stocks. And once you apply leverage correctly, the return on your actual invested capital in strong rental markets runs between 15 and 30% per year. Private commercial real estate held for investment has returned approximately 10.3% annually over 25 years. REITs, which are real estate investment trusts you can buy through any stock brokerage, have averaged between 10 and 12% annually including dividends, which actually edges out the S&P 500 over the same period. So when someone says stocks beat real estate, they are usually comparing stock returns to residential appreciation only. Which is like saying cars are faster than bicycles while ignoring that the person on the bicycle has a jet engine attached. The leverage is the jet engine. You cannot ignore it. Let us run the real numbers now. With a real scenario. Because abstract percentages mean nothing until you see them applied to an actual starting point. Scenario 1. You invest $30,000 in an S&P 500 index fund. You add $500 every month. The historical average return is 10% annually. After 30 years, your portfolio is worth approximately $1,100,000. You contributed roughly $210,000 of your own money over that time. Compound interest and market growth delivered the rest. You never managed anything. You never fixed a leaking pipe. You never dealt with a tenant. Your investment was completely passive. Scenario 2. You use $30,000 as the down payment on a $150,000 rental property in a reasonable market. You take a 30-year mortgage at the current rate of approximately 7%. Your monthly mortgage payment is approximately $998. Market rate rent in a typical rental market covers your mortgage, taxes, insurance, and maintenance and leaves you with $300 to $600 per month in net cash flow after expenses. Your tenant is paying down your mortgage every single month, building your equity without any additional money from you. Over 30 years at 4% annual appreciation, that property grows from $150,000 to approximately $486,000. Your tenant paid off the entire $120,000 mortgage. You now own a $486,000 property free and clear. You also collected an average of $450 per month in net cash flow over that time, which adds up to $162,000 over 30 years. Total wealth created from real estate, $486,000 in equity plus $162,000 in collected cash flow, equaling approximately $648,000. The S&P 500 scenario with $500 monthly contributions delivered $1,100,000. The single rental property scenario delivered $648,000. Stocks win in this comparison. But here is the variable that changes everything. Most real estate investors do not stop at one property. They use the cash flow and equity from property 1 to acquire property 2. Then properties 1 and 2 to acquire property 3. Each property adds another stream of cash flow, another mortgage being paid down by tenants, another asset appreciating. A disciplined real estate investor who builds a portfolio of 10 properties over 30 years, each producing similar numbers, creates $7 to $10 million in equity and cash flow. Scaling stocks requires proportionally more of your own money. Scaling real estate uses the bank's money and your tenant's money to do most of the work. Now here is where the analytical narrative demands honesty. Because real estate is not universally better, and I will not pretend it is. Stocks are dramatically simpler. You open a Fidelity account, buy an index fund, set up an automatic monthly contribution, and do nothing. No tenants. No maintenance. No property management companies. No evictions. No vacancy months where you still pay the mortgage even though no rent is coming in. No dealing with a boiler that breaks in January. No property taxes. No landlord-tenant law to navigate. Stocks win on simplicity in a way that real estate can never match. Stocks are also infinitely more liquid. If you need money, you can sell stocks tomorrow. Selling a property takes weeks to months, costs 5 to 6% of the sale price in realtor and closing fees, and is subject to market timing in ways that can significantly affect how much you actually receive. And stocks require far less starting capital. You can start investing in the S&P 500 with $1 on Fidelity today. Starting in real estate requires a down payment, closing costs, reserves, and the credit score to qualify for a mortgage. The barrier to entry is meaningfully higher. Real estate wins on tax advantages that most people never account for correctly. The depreciation deduction alone adds 2 to 4 percentage points to your after-tax return compared to equivalent performing stocks. On a $200,000 property where the structure is valued at $160,000, you receive a $5,818 annual tax deduction even though the property is not actually losing value. For someone in the 24% tax bracket, that is $1,396 per year in pure tax savings from a phantom expense. The 1031 exchange, which allows you to sell a property and roll all the profit into a new property without paying capital gains tax, is one of the most powerful wealth preservation tools in the American tax code. Stocks do not have an equivalent mechanism. Every profitable stock sale triggers a capital gains tax bill immediately. So here is the honest answer that the data demands. If you want simplicity, liquidity, lower starting capital, and genuinely competitive returns without ever managing anything, stocks in a low-cost S&P 500 index fund are the superior choice and have been for most of the last 100 years. If you want maximum leverage, passive monthly income, the most powerful tax advantages available to ordinary Americans, and the ability to scale your wealth using the bank's money and your tenant's rent rather than just your own contributions, Real estate is the superior wealth building vehicle for people willing to put in the operational work. And here is the conclusion that most serious wealth builders have arrived at after running the same numbers you just saw. The real answer is both. Stocks for the liquidity, the simplicity, the consistent compounding, and the diversification. Real estate for the leverage, the cash flow, the tax advantages, and the forced equity building. These two assets are not competitors. They are complements. And a portfolio that includes both consistently outperforms a portfolio built entirely on either one alone. The wealthiest ordinary Americans are not choosing between real estate and stocks. They are choosing how much of each, and when. Now before you go, I want to know if the math changed your answer. Go back to your first comment right now. Did you pick real estate or stocks before the numbers came in? Does the data agree with your gut? Drop your updated answer below. I check every comment on this channel and I genuinely want to see how many people the math moved. If this video finally made both investments make sense in a way they never did before, give it a thumbs up and share it with one person who is still choosing between these two instead of understanding why they need both. Subscribe to Rich Habits. I will see you in the next one.